What is happening, crypto fam? Welcome back to Bitcoin Bulletin, your ultimate source for the pulse of the digital asset world. The market is absolutely electric right now, moving at warp speed, and if you're not plugged in, you're missing out. We've got a packed show today, with developments that could reshape how we see major digital assets and innovative ways to grow your portfolio. Get ready, because you're about to get the unmissable updates you need to stay ahead. Let's dive straight into the action. First up, we're tackling a question that's on everyone's mind. Can Ethereum truly challenge Bitcoin's dominance in the world of institutional capital? We're seeing some fascinating shifts in where the big money is flowing, and the implications are massive for the future of digital finance. Is a new king about to emerge, or is the original still holding strong? You won't want to miss this deep dive. Then, we're connecting the dots between tech giants and digital currencies. Nvidia's latest earnings report is out, and we're analyzing its relationship with Bitcoin. Remember when these two seemed perfectly in sync? Well, the market is evolving, and we're breaking down whether that strong correlation is starting to fade. What does this mean for investors looking at both the booming tech sector and the volatile crypto space? But wait, there's more. Ever wondered if you could mine Dogecoin without the hassle of expensive equipment? We've got news on a new method that lets you use your Bitcoin to remotely mine Doge, promising real-time daily returns. Could this be the passive income stream you've been looking for, or is there more to the story? We're unpacking the details of this innovative approach. And finally, we're going deep into the rise of Bitcoin treasury companies. What's driving this trend? How are securitization, jurisdictional arbitrage, and corporate leverage playing a role? We're discussing whether these companies are a healthy on-ramp for Bitcoin or just a speculative bubble, and what their fate might be when the market turns. Plus, we're examining the strategies, the ethics, and the potential impact on public markets. It's all here, so buckle up and get ready for the insights. Don't forget to smash that like button, subscribe if you haven't already, and ring that notification bell so you never miss an update. Ethereum's institutional ascent. Can ETH surpass Bitcoin in capital inflows? In the dynamic world of digital assets, a pivotal question is emerging. Can Ethereum, the second largest cryptocurrency, begin to rival or even surpass Bitcoin in attracting institutional capital? This isn't just about price movements. It's about the fundamental flow of investment into the digital asset space. As traditional finance increasingly eyes cryptocurrencies, the battle for institutional adoption is heating up, and Ethereum's position is becoming a key focus for market watchers. The landscape of institutional investment in crypto has traditionally been dominated by Bitcoin. Its status as the first and most well-known cryptocurrency, coupled with its perceived role as a digital store of value, has made it the primary entry point for many large investors. However, the narrative is evolving. Ethereum, with its vast ecosystem of decentralized applications, dApps, smart contract capabilities, and the ongoing transition to Ethereum 2, now referred to as the merge and subsequent upgrades, presents a compelling case for a different kind of institutional interest. This interest is often driven by the potential for utility, yield generation through staking, and participation in the burgeoning decentralized finance, DeFi, and NFT markets that are largely built on Ethereum. Analysts are closely observing the inflows into Bitcoin versus Ethereum products, such as exchange-traded funds, ETFs, and other investment vehicles. While Bitcoin ETFs have seen significant uptake, the development and potential approval of Ethereum-based investment products in various jurisdictions could unlock a new wave of capital. The argument for Ethereum's institutional appeal lies in its utility beyond just a store of value. Its role as the foundational layer for a vast array of financial and technological innovation attracts investors looking for exposure to the growth of the decentralized web. Furthermore, the potential for staking rewards offers an income-generating component that is less pronounced with Bitcoin, appealing to a different set of institutional mandates. However, challenges remain. Regulatory clarity surrounding Ethereum, particularly regarding its classification as a security versus a commodity, continues to be a point of discussion and potential friction for some institutions. Bitcoin, having navigated some of these early regulatory waters with greater clarity, still holds an advantage in terms of established institutional familiarity and perceived safety. the sheer depth and liquidity of the Bitcoin market also provide a significant anchor for large-scale capital deployment. The question is whether the unique utility and growth potential of the Ethereum ecosystem can overcome these hurdles and draw capital away from the established leader. This evolving dynamic is crucial for understanding the future trajectory of the digital asset market. The competition for institutional capital not only influences asset prices, but also shapes the development and adoption of blockchain technology itself. The outcome could determine which cryptocurrency becomes the primary gateway for traditional finance entering the digital asset realm. Will the momentum behind Ethereum continue to build, challenging Bitcoin's reign? Next, we're diving into the fascinating intersection of semiconductor giants and the digital currency market, exploring a potentially fading correlation. Nvidia's earnings and Bitcoin. Is the correlation weakening? In the fast-paced world of technology and finance, the relationship between major tech company earnings and the cryptocurrency market has often been a talking point. Specifically, the performance of Nvidia, a leading designer of graphics processing units, GPUs, crucial for both gaming and cryptocurrency mining, has been closely watched for its potential impact on Bitcoin. However, as the market matures and evolves, a key question arises. Is the once strong correlation between Nvidia's earnings and Bitcoin's price action beginning to weaken? Historically, Nvidia's stock performance and Bitcoin's price have shown a notable degree of correlation. This link was particularly evident during periods of intense cryptocurrency mining activity, where demand for Nvidia's powerful GPUs surged, driving up the company's revenue and stock price. Consequently, a strong Nvidia earnings report often coincided with positive sentiment and upward price movements in Bitcoin, as it signaled robust demand within the mining ecosystem. This correlation was seen as a barometer for the health and expansion of crypto mining operations, a significant component of the Bitcoin network's infrastructure. However, several factors are now prompting a reevaluation of this relationship. Firstly, the cryptocurrency market itself has diversified significantly. The rise of alternative consensus mechanisms, such as proof-of-stake, POS, which require less computational power and thus fewer specialized GPUs, has reduced the direct reliance on Nvidia hardware for a growing segment of the crypto space. Ethereum's successful transition to POS, for instance, removed a major driver of GPU demand that had previously benefited Nvidia. Secondly, the broader economic environment and investor sentiment play a more dominant role. Factors like inflation, interest rate policies, geopolitical events, and overall market risk appetite can influence both tech stocks and cryptocurrencies independently, potentially decoupling their movements. Moreover, Nvidia's business is increasingly driven by demand from sectors beyond cryptocurrency mining, most notably artificial intelligence, AI, and data centers. The company's recent earnings reports have highlighted its dominance in the AI chip market, which has become a primary growth engine. As AI applications expand, Nvidia's financial performance may become more closely tied to the trajectory of AI development and adoption, potentially overshadowing its historical connection to crypto mining. This shift means that, while Nvidia's earnings might still be a bellwether for technological innovation, their direct impact on Bitcoin's price could be diminishing. Market analysts are carefully dissecting these trends. Some argue that while the direct correlation might be fading, an indirect link remains. A strong Nvidia report, signaling robust demand for advanced computing, could still be interpreted as a positive indicator for technological progress, which broadly benefits growth-oriented assets like Bitcoin. Others contend that the market is now more sophisticated, with investors analyzing crypto assets on their own fundamentals, regulatory outlooks, and macroeconomic factors, rather than relying on proxy indicators like Nvidia's earnings. The key takeaway is that the once clear relationship is becoming more nuanced, requiring a more sophisticated approach to understanding the interplay between these markets. As the crypto world evolves, so do the forces that influence it. What does this mean for your investment strategy? Get ready to explore a unique opportunity that could change how you think about passive income in the crypto space. Mine Dogecoin with Bitcoin, the SolMining opportunity explained. In the ongoing quest for passive income streams within the ever-evolving cryptocurrency landscape, new and innovative methods are constantly emerging. For investors looking to diversify their holdings and generate returns without the intensive capital expenditure typically associated with mining operations, a novel approach has surfaced: using Bitcoin to remotely mine Dogecoin through the SolMining platform. This method promises real-time daily returns, potentially lowering the barrier to entry for participating in the mining economy. The core concept behind this SolMining model is to leverage existing Bitcoin holdings to generate Dogecoin. Instead of acquiring specialized, high-cost mining hardware or dealing with the technical complexities of setting up and maintaining mining rigs, users can reportedly deploy their Bitcoin capital through SolMining's cloud infrastructure. The platform claims to facilitate this process, transforming idle Bitcoin into a source of daily Dogecoin rewards. This approach aims to simplify mining participation, making it accessible to a broader audience, including those who may not have the technical expertise or the substantial upfront investment required for traditional mining. SolMining positions itself as a global cloud mining platform with a focus on sustainable energy practices. Founded in 2017 and based in the UK, the company emphasizes providing efficient, secure, and transparent computing services. The platform supports a range of cryptocurrencies, including Bitcoin, Dogecoin, and XRP. A key differentiator highlighted by SolMining is its commitment to utilizing renewable energy sources, such as solar, hydropower, and wind power, for its data centers. This focus on low-carbon operations aligns with growing environmental consciousness within the tech and finance sectors. The operational model reportedly involves flexible, short-term smart contracts, which offer users a degree of adaptability in their investment. The platform touts a stable revenue mechanism and flexible payout channels, allowing users to receive their earnings in multiple currencies. This ease of participation, without the need for direct hardware management or deep technical knowledge, is presented as a significant advantage. One user testimonial suggests that the ability to earn daily Doge rewards by simply putting Bitcoin capital to work without extra effort is a compelling proposition for those seeking stable, convenient, and sustainable income avenues. By enabling Bitcoin holders to mine Dogecoin, SolMining aims to not only reduce the investment threshold, but also contribute to the vitality of the Dogecoin ecosystem. The platform's emphasis on transparency and immediate returns is designed to build trust and appeal to investors seeking reliable passive income. This model represents a potential new avenue for capital deployment, merging the stability of Bitcoin with the potential upside of Dogecoin mining through a simplified, cloud-based service. Could this innovative approach to Dogecoin mining be the next big thing in passive crypto income? Stay with us as we delve into the complex world of Bitcoin treasury companies and what they mean for the future of financialization. The rise of Bitcoin treasury companies, financialization or bubble. The financialization of Bitcoin is accelerating, marked by the emergence and growth of dedicated Bitcoin treasury companies. These entities are fundamentally changing how capital interacts with Bitcoin, employing sophisticated financial strategies like securitization, jurisdictional arbitrage, and corporate leverage to build their portfolios. This new wave of Bitcoin-backed equities prompts a critical question. Is this a healthy, accessible on-ramp for broader adoption, or merely a speculative bubble set to burst in a bear market? Stephen Lubka, a key figure in this discussion, unpacks the strategic playbooks of these companies. Their approach often involves running higher leverage, establishing a global network of local operating vehicles, and utilizing mergers and acquisitions, M&A, to accumulate Bitcoin at scale. This aggressive strategy, sometimes dubbed the paper Bitcoin summer thesis, aims to embed Bitcoin into public markets, offering millions of investors indirect exposure without the direct complexities of holding the cryptocurrency itself. However, this strategy also raises significant ethical and risk management questions. Critics argue that these treasury companies might be a form of shitcoining, essentially repackaging Bitcoin into complex financial products that obscure underlying risks and create artificial demand. The morality of these treasury operations is a subject of intense debate. Proponents argue that they are a necessary evolution, democratizing access to Bitcoin for a wider audience and integrating it more deeply into the traditional financial system. By creating regulated, accessible investment products, they can attract capital that might otherwise stay on the sidelines. This integration, they believe, strengthens Bitcoin's network effect and legitimizes its role as a financial asset. On the other hand, detractors point to the inherent risks associated with leverage and securitization, particularly in a volatile market like cryptocurrency. The potential for these companies to amplify downturns through forced selling or margin calls is a significant concern. Understanding the mechanics is crucial. MNAV's market cap to net asset value and premiums paid for these Bitcoin-wrapped equities are key indicators of market sentiment and potential overvaluation. In a bull market, premiums can soar, driven by speculative fervor. However, in a bear market, these premiums can evaporate rapidly, exposing the underlying leverage and potentially leading to significant losses for investors. The jurisdiction in which these companies operate also plays a vital role, as regulatory arbitrage can offer advantages but also introduce unique risks and compliance challenges. The debate centers on whether these financial innovations represent a maturing of the Bitcoin market or a dangerous proliferation of complex, high-risk derivatives. Are they a genuine step towards embedding Bitcoin into the global financial infrastructure, providing millions with a passive, albeit indirect, exposure? Or are they a sophisticated mechanism that could ultimately destabilize the market by introducing excessive leverage and opaque risk structures? The answers will shape the next phase of Bitcoin's financialization and its long-term trajectory. As these treasury companies navigate the market, their strategies will be tested. Will they lead to broader adoption or greater volatility? That's all the news for today, but we'll be right back with a quick recap and your essential call to action. And that's a wrap on today's essential updates. We saw Ethereum making waves in institutional capital, potentially challenging Bitcoin's dominance. We analyzed the shifting correlation between Nvidia's earnings and Bitcoin's performance. We explored a unique way to mine Dogecoin using Bitcoin with SolMining, and we dove deep into the rise and risks of Bitcoin treasury companies. Don't miss out on future insights. Hit that like button, subscribe to Bitcoin Bulletin for your daily dose of crypto news, ring that notification bell so you're always in the loop, and follow us on all social media platforms to join the conversation. See you next time.